Hello, everyone, and welcome to Credit in the New Normal. Thank you for joining us for this webinar from the BWorks Research Institute. We have a lot to cover today. As all of you know, the world's an interesting place today, and the way that credit is being used by consumers and the interaction with financial institutions as well as policy is a fascinating topic and one that warrants a fair amount of discussion. Before we get down to business, let's just talk a little bit about the organizations behind this webinar. And next, I'll introduce our speakers. So we can go to the next slide. So BEworks is the world's first commercial consulting team dedicated to the application of BE to real-world challenges. And BEworks founded the Research Institute to zoom out a bit and ask big questions about human behavior that haven't been asked yet have this incredible impact on society and the economy. And a lot of the philosophy of the Research Institute ties back to this notion that scientific thinking is something that's within all of us and enables us to ask big questions like why, how do you know, and even the aspirational ones like what if. So today you can expect a mixture of behavioral insights around particular trends we're seeing, but also some orientation to the big questions that we are interested in trying to answer through scientific inquiry and the ones that we think are of most interest to financial institutions, policymakers, and consumers today. So as we progress through the talk, I encourage you to ponder what exactly amongst these questions are the most critical for you and your organization. So today we have a number of us speaking. To kick off, I'll introduce the president of the BEworks Research Institute, Dr. David Lewis. David holds his PhD in marketing with a specialization in consumer behavior from the Lazarides School of Business and Economics at Wilfrid Laurier University. He also holds an MBA in strategy and finance from Schulich at York University. And in addition to this academic training, David's also a chartered financial analyst. And prior to joining BEworks and heading up the Research Institute, he was an assistant professor at the Ted Rogers School of Retail Management at Ryerson and held numerous senior positions in the financial services industry, enough that I have to read them. I can't remember them all. He was the CMO and Chief Information Technology Officer at ING Direct USA, the head of banking at Barclays Wealth USA, head of banking products at UBS Financial Services USA, and board chair at UBS Bank USA. And in addition, serves on the board of a number of financial services companies in Canada. He was dubbed one of the top 50 marketers in the US by Ad Age magazine. And today he leads all the research initiatives out of the Institute. We're also joined today by Michelle Hilscher, who is the Vice President of Discovery and Behavioral Diagnostics. She earned her PhD in psychology from the University of Toronto. For the past over 5 years now, Michelle has provided BE expertise and advisory support to a range of organizations, including the OSC, IFIC, BCSC, Sun Life, and TD Bank. Here at BEworks, Michelle leads various complex projects with a number of major financial institutions and regulatory bodies related to financial decision-making, compliance, transparency, regulation, and risk. Now, as for myself, I'm Nate. I'm a scientific advisor here at BEworks, and in addition, I'm a professor of creativity and creative thinking at Sheridan College, just outside the city. My PhD is in cognition, earned that at the University of Waterloo. I've published widely on a number of relevant topics, including the intersection of the human mind with technology, how behavioral science influences and interacts with trends seen in the fourth industrial revolution. And my primary duties here at BEworks involve orienting us to some of the thought leadership discussed here today. Now, moving forward, that's the cast of characters you can expect. Let's think about what we're going to talk about more concretely. We're going to start by figuring out which trends are at the top of the list that financial institutions, policymakers, and consumers should be pondering, and how that relates to behavioral economics. And we'll move forward by applying this BE lens to understanding credit in the new normal. And finally, we'll close with consideration of the implications for these diverse stakeholders in society today, with a particular emphasis, as I said, on what are the big questions that need answered and how can we collaboratively and collectively start to ascertain how these trends intersect with some of the most important concerns of all segments of society. So when we start thinking about credit in the context of the new normal, we can start to see immediately that things are a bit more subtle and nuanced than perhaps the macroeconomic forecasts are telling us. And as I'm about to turn it over to David, there's a number of factors underlying these trends, which will be shortly introduced. For one, we need to start segmenting a bit more nuanced models that take into account distinct segments of the population. And further, once we drill down to that level, we really need to start thinking behaviorally and go inside the minds of the people that are navigating this new landscape and trying to calibrate their use of credit in the new normal and ponder how organizations and governments can in turn make the most of these trends and help everyone flourish. So with that, I'll turn it over to my colleague David, who will tell us a bit about these trends and what we think is going on.
Thanks, Nate. The macro level numbers look good. Overall household debt's down, spending is down, a lot of it due to the fact that spending has been constrained. But digging under that, 67% of Americans are still not financially healthy. And these macro level statistics really hide a lot that's going on underneath. Bank of Canada recently reported that a third of Canadians are either unemployed or underemployed. And this has been called a K-shaped recovery, but the IMF is referring to it as divergent recoveries, where some segments are saving more and borrowing less and doing well, but a sizable segment is still reliant on government COVID-19 support payments, and they're struggling financially, and they're turning to credit. So in looking at what's going on there, we can look at the way traditional economics looks at consumer behavior and consumer decision-making. And the assumption is that they're unboundedly rational. And that has a specific meaning here. It doesn't mean sensible and thoughtful. What it really means, it's a very precise definition. It says that when people make decisions, they're calculating, analytical, goal-oriented, consistent, and even predictable. However, behavioral economics says that we're boundedly rational. And if you think about the way traditional economics would assume that people behave, it assumes that they behave in a rational manner. Yet, when we observe their actual behavior, we see that they may attempt to be boundedly or attempt to be rational and do their best to be rational. But there's a number of cognitive limitations and emotional impacts and contextual impacts that mean that our behavior isn't necessarily strictly rational. The traditional economic normative expectations of behavior are violated. As an example, we make credit decisions that are focused on the present and clearly ignore the long-term consequences and create harm for ourselves. We don't save enough for retirement. We're happy in the present, but much less happy in the future. We fail to seek and follow professional advice. In investment decision-making, my area of study, we're often myopic and risk-averse so that we make suboptimal investment decisions. Think of market timing, excessive trading, insufficient diversification, herding behavior. You think about meme investing and GameStop. That shows that while we can assume people are rational decision makers, in fact, they're boundedly rational, and that has implications. And as we look at it and start to research what the implications of being boundedly rational are, we've identified top 5 trends in consumer behavior that are really going to be the core of what we're going to talk today. Number 1 is increasing demands on our attention is causing scarcity mindset. And scarcity mindset has specific impacts on how we think and how we make decisions. As well, the recent introduction and recent growth of buy now, pay later, which is a new means of transacting and a new means of short-term borrowing, is leading to very short-term thinking and borrowing for immediate pleasure, but that has long-term consequences. Another trend we've identified is the popularity of personal finance apps. Unfortunately, these are compartmentalized rather than holistic, and they're changing our financial behavior for the worse. Another trend we've identified is the increasing use of intangible payments. When payments are intangible, it reduces the pain of paying and increases the likelihood that we'll spend beyond our means. Finally, another important trend is real estate price appreciation. That's causing speculation, excessive risk-taking, stretched valuations, suboptimal investment decisions for some, and for others, reduced home affordability. At this point, I'm going to pass it over to Michelle, and we're going to talk about each one of these 5 trends in detail.
Thanks a lot, David. I think scarcity mindset is nothing new. It's been around, it's been influencing people for a long time. But I do think that the pandemic that we're living through has kind of put a bit of a spotlight onto behaviors that it is likely responsible for, be that, something like credit seeking or toilet paper hoarding for that matter. Scarcity mindset hits when people feel like they don't have enough. And I think we typically, imagine it in the context of not having enough money, but it also is something that influences people when they don't have enough time or they feel like, maybe they don't have enough social companionship. Certainly in the context of what we're discussing today, it is something that can happen when people feel like they don't have access to enough credit even. So what happens when people are experiencing this scarcity mindset is that decisions making itself actually changes shape. And you find that people tend to rely more on mental shortcuts or biased thinking because they're so focused on, the present moment, the needs that they have, and the deficits that they feel that they're experiencing. So if we're looking at, the effects of scarcity mindset, this is certainly a widespread set of, experiences that people are having. I think it's very likely that during COVID-19, the pandemic, that you're seeing these different effects taking place to impact people's decision-making, particularly, people who may have been negatively impacted through job loss or, social isolation. As we make our way through the pandemic, I think the other thing to note is that it's not just going to go away. Perceived scarcity is going to continue to influence people's behaviors as they cope with long-term ramifications that, have connection to previous decisions they would have made. So scarcity mindset, what's it actually look like? It is firstly encouraging something called present bias, where immediate needs are really what overtake attention and future concerns kind of get backburnered. This can mean that things like long-term planning, they are just happening less often, and that people don't really think a lot about the consequences of those immediate actions. Those things are kind of less top of mind because of that present bias. When it comes to problem solving, so for instance, in the area of how to manage debt, you've got this constant worry that really is depleting your ability to be good at problem solving and finding solutions. Something called tunneling has been really well documented. It's a key symptom of scarcity mindset, actually. And what it means is that you don't see the help. You don't see the solutions that are available to you, even though you're looking for them. You are essentially, just not able to see that they're there for you. So those are some of the key, impacts of scarcity mindset. In terms of scarcity mindset and the implications that it has, I think that, it really is relevant to consumers. It's certainly relevant to policymakers and lenders alike. So the mindset negatively impacts consumers' overall financial health. That's because it's really leading to a number of different behaviors that aren't optimal. So that could include things like taking on more debt than what you maybe need because, you want to have it. You want to have that credit just in case. Paying off some debt, but maybe not all that one could actually afford to repay. And again, it's because it feels safer to have cash in the bank than to wipe out outstanding debt. Taking advantage of payment holidays. So we've seen that trend for sure, where people, they could pay their mortgages that month, but to be on the safe side, they choose to cash away the cash. Spending on credit to secure small pleasures that feel good in the moment. That again is something really characteristic of scarcity mindset, because when you are experiencing this feeling of not having enough, you kind of want to feel good for a minute. And so it's quite conceivable that you will spend on little things that you can get access to right away to kind of offset that negative feeling of perceived scarcity. And that last point that I had made, where people are maybe a bit underwater, they're in trouble, but they miss seeing and taking advantage of assistance that actually is there for them. So that's the consumer implication. Now, in that this mindset may erode consumers' financial health, which we know is a key predictor of overall well-being, scarcity mindset poses implications for policymakers as well, who are obviously concerned with the health of society as a whole. And finally, for lenders, besides wanting to have happy customers, the implications are that scarcity mindset changes how people are thinking and behaving. And it means that past behaviors that you may have data on, that they're not as reliable. And lenders need to actually factor scarcity mindset into their models and adjudication of creditworthiness, as well as how they're interacting with customers to try and alleviate problems once they emerge. So how might we, as behavioral scientists, apply these type of insights to help in situations where people are experiencing this kind of scarcity in their lives? Well, a first line of defense, I would say, is to help consumers experiencing scarcity mindset by simplifying the choice architecture. So, reduce the amount, reduce the complexity of information that they need to consider for any particular decision that they're making. This is going to help to ensure that they're able to find and make use of essential information, like the essential details they absolutely need. Whether that would be, features of a credit product, or maybe it's the steps in a repayment plan. Despite being in this frame of mind that we know is exerting a bandwidth tax on decision making. Another thing is that an aspect of scarcity mindset that you can't lose sight of is the fact that there's a big sensitivity. People have a big sensitivity to trade-offs and the fear of hidden costs, including the time that they might need to invest in order to, maybe take advantage of some sort of program or support that's available to them. So anticipated hassle costs, they can loom large enough, in fact, that they stand in the way of consumers taking advantage of supports, such as financial advice or credit counseling. So to encourage consumers to connect with supports that are accessible to them, it's crucial to address any overestimates they may have made about the time needed to get started. I think the last point here is that it is going to most likely be very important to identify immediate and tangible benefits that consumers can achieve within, a short time of getting started. For instance, if they're looking for support in managing debt. You can make these benefits non-monetary, in fact. And I mean, that's something that's been shown to be very effective, though I think it's often, kind of a counterintuitive insight that you can help people by offering supports that aren't, just monetary in nature. And, there's a lot of research out there, including work that we've done at BEworks, that really underlines this point. We had worked with, households who are suffering under the burden of high energy costs. So, being smacked with big electricity bills. And, there are a lot of programs out there that these type of households can take advantage of, where they can get free renovations to the home to really offset the cost of energy. And we found, not surprisingly, that these programs aren't being fully taken advantage of. There are a lot of households that are eligible who simply are not signing up. And what we found is that many of these households are certainly experiencing, something that most likely is a scarcity mindset. And the way to help these households take advantage of the programs is not to just emphasize that you will save money, because that's something that you have to wait for. And consumers really, are in a mindset where they are focused on the present moment. So instead, what we developed were, messages that emphasized what you stand to get tomorrow. If you go through and you get these sorts of upgrades done, then you're going to get a brighter home because you've got the LED lights. You're going to have a quieter furnace. You're going to have a warmer home. So things that help to offset the feelings of that scarcity. They can be very appealing in helping to get people to take action. I'll turn things back over to you, David, and you can tell us a little bit more about buy now, pay later products.
Thanks, Michelle. Buy now, pay later is making a lot more noise. It's relatively new. It's a new means of making payments, so it offers transactions, but it also offers an easy means of credit, an easy way to finance those purchases and pay them over time. It's essentially a consumer installment loan that's originated at the point of sale when making a purchase. It's growing. There was over 50 million transactions by US consumers last year. The average amount's increasing from $400 to $480 per transaction in 2020, and it's $24 billion in the US alone. There's no interest as long as the balance is paid on time for most, but other forms of buy now, pay later actually have very high fees and very high interest. Sometimes it's targeted for convenience with seamless integration with retailers, but in other cases, it's targeted at consumers who maybe don't have enough room left on their credit cards or no longer have credit cards and need some means of making payments or making transactions online. It can be good if people can stick with the plan. One of the advantages of buy now, pay later is that it has a scheduled repayment period with specific payments over time, and you can avoid the fees and you can avoid interest charges if you stick to the payment plan. However, about 24 respondents in a recent study have below prime credit, and 27% have more debt than they can manage. The concern here is that coupled with scarcity mindset, buy now, pay later can make it easy for consumers to overextend themselves. There may be, an appeal in that consumers say, I'm worried if I put it on my credit card, I'm not going to pay it off. But if I have a scheduled repayment period and know exactly when I need to make the payment and what payment, then I'm going to make the payments on time and ensure that I actually keep current. And there is research, behavioral science research, that actually shows when people can tie a specific payment to a specific purpose, I'm paying off those shoes. And an interesting thing here is that a lot of these are targeted at everyday purchases, like makeup, for example, rather than large ticket items, which typically might have been consumer debt. The challenge here is that we know consumers are overly optimistic. They're overly optimistic regarding their ability to economize in future months and use the freed up cash to make payments. They think they can save more and spend less in the future. However, in reality, 43% of buy now, pay later users were late on a payment. The best of intentions, in fact, then don't actually often come to fruition. For example, Cardify, a payments research firm, found recently that 2/3 of respondents reported using buy now, pay later to buy something that they wouldn't normally have purchased if buy now, pay later wasn't available. The concern here is, again, with scarcity mindset, people are using this as a means of financing small pleasures in the present and ignoring the long-term cost. The implications: scheduled repayment is good, but scarcity mindset makes it more likely that buy now, pay later will be abused. Consumers need to carefully consider the use of credit. They need to think about whether this is a means of transacting or whether this is really just a means of building up debt and enjoying current consumption at the expense of future. For some consumers, particularly at the low end of the credit spectrum, buy now, pay later makes it an easy way for them to accumulate more debt than they really should. And policymakers really need to think about the risks of buy now, pay later for those segments. And lenders as well, there's a concern because a lot of buy now, pay later is not on the traditional credit bureau. And many lenders may be unaware of the dangers lurking in their credit card portfolios because their consumers, their customers, may have more debt than they realize. In thinking about how behavioral economics can be applied to the challenges of buy now, pay later, it's good to encourage consumers to think about atypical payments. When people plan for next month's expenditures, they often forget and it's called a bias is called atypicality neglect, where if you ask people what they're going to spend money on next month, they talk about what they typically and usually spend money on every month, and they don't think about the fact that every month something comes up, whether it's a home repair or a vet appointment or a car repair. Those are atypical payments and people forget about them. And they then anchor their spending predictions based on the things they're more familiar with and neglect these atypical payments. But the atypical payments are very real and have a very real impact on their ability to repay the buy now, pay later debt. Another way to help is with something called mental time travel, and that is envisioning your future self. We have what is called an empathy gap, where our future self is almost like a stranger to us. We don't think of that future self as being ourselves, and we're more likely to enjoy and have hedonistic pleasures in the present because that future self who's going to pay for it is a psychologically distant person. We've done research a couple of different occasions, in one case with a global bank, where we had people envision or engage in that mental time travel and envision their future self. And they're more likely to save more money for that future self because they see it as more psychologically attached to themselves, and it overcomes that empathy gap. And finally, lenders can help customers use credit and buy now, pay later responsibly if they encourage customers to do that, if they encourage customers to think about their future self, if they encourage customers to step back and try and overcome that scarcity mindset and try and overcome that empathy gap. Buy now, pay later and credit cards are tremendous convenient. They're very useful for transactions. But the downside is that it can mean that people can become overextended financially, and that causes collection costs and credit losses. And with that, I will turn this back over to Michelle.
Great. Thanks, David. So now what we're going to do is turn our attention to the third of our themes. And, this is really the question of what happens when you bring in a financial technology of some sort to help consumers. Certainly, there's been an uptick in smartphone apps, digital platforms that are, there to help consumers manage their finances. And I think in the wake of lockdowns, more people are at home, they're doing online shopping, they're doing lots of things online, that we're seeing more consumers adopting these sorts of technologies and starting to integrate them into their day-to-day lives. While the prevalence of the personal finance app holds a lot of promise, so helping in all sorts of domains from budgeting and spending to credit management to savings and investing, and certainly these sorts of technologies come equipped with a multitude of features from convenience to real-time impact, I think that a behavioral reality check is necessary. And what it reveals is that this promise may not be proven out. So for one thing, obviously there's the question of access. So while the fintech market's large and growing, many groups may be excluded. This would include lower income households, for instance, who may have less access to devices and apps. And of course, parts of the population who are just generally not big technology users. Beyond these factors, though, if we apply a behavioral lens, a behavioral perspective, there are other challenges in addition to access. So with an app for every aspect of one's personal finances, there's really a risk of people starting to think about their personal finances in a very compartmentalized way, when in reality, personal finance is an integrated whole. We need people thinking holistically about how, something like saving and credit and investing, like how do they actually relate to each other? Apps may make it actually very easy for people to break apart their financial lives and spend time focusing on one area of it to the detriment of others. This could mean building a savings habit, but not dealing with debt, for instance, or in the arena of debt, maybe setting up something like an automatic repayment plan, but not looking to control overspending, which would also be really important. The licensing effect is another concern. So simply downloading an app may actually license subsequent self-defeating behaviors in the financial realm. So that could mean, people download this app, they feel they're getting on top of things, and they feel licensed to splurge and get out there and make some purchases. Or perhaps because they've got this app, they know it's going to help them, that they kind of choose to maybe pay back the minimum balance when they could pay back more, that would be possible. I think another important lesson that behavioral science has to share is that we need to keep in mind when we build technologies of any kind that defaults are good, right? Pre-selecting, making some choices for consumers is good. It can help users to do better by helping them, set and forget actions that would otherwise be hard for them to do over time. So automating their credit card payments, for instance. So defaults can be good, but when users are comfortable with defaults, we have found, behavioral science, the field has found that, this makes people passive. It means that they're actually going to have a very hard time taking control when the time comes to do away with the default and change their course of action to accommodate things that may have cropped up in their lives. So if I'm thinking of an example, you can default people into being pension plan members, but that means they become passive. So they go with the automatic suggested rate of contribution. They don't come back to the table to rebalance their assets, those sorts of things. And if you're thinking about behavior, it's not a one-time thing, right? Financial behaviors, we're trying to encourage a journey where people make multiple behavioral choices over time. So fully automating decisions means users can lose touch with the why and have a hard time course correcting if the default no longer is serving them. So how do we apply behavioral insights to the realm of technology, personal finance apps? So to unlock the value, and we can be talking about a credit app, we can be talking about a personal finance app more generally, we need a choice architecture that incorporates behavioral principles. And on this slide, there's some examples here of what this could look like. So the first one that we can talk about is something called whole unit framing. The point to underline is that context matters a lot, and the way that we set the table has a big impact on consumer behavior. So if we're taking, for instance, that whole unit framing, when we show that several behaviors are related and an outcome is really only achieved if you've done each of those things, this can motivate more effort on the part of consumers. So if we're looking here, and we're trying to get people to develop, very healthy credit behaviors, we might use whole unit framing to communicate that budgeting is not enough on its own. Impulse repayments isn't enough on its own. Automating repayment is not enough on its own, that you need to actually be doing multiple behaviors to achieve that outcome. One last thing to note, personal finance apps, as I say, they do run the risk of overloading consumers with more choices and decision difficulty than is needed or prudent. And you can certainly use defaults, so make some decisions for users so that it reduces the choice complexity. The challenge with that, besides introducing this feeling of passivity, is that you may have people who feel like, they really aren't having any choices given to them at all. So it maybe locks them out from the beginning when you're trying to get them to engage with a technology platform. So I think the additional point here could be that you want to do some testing and see how you can use behavioral strategies to achieve the behaviors that you're looking for in users. Next, we're going to move into discussing this question of intangibility and how it is that people think about money, how that actually connects to the way that they spend and repay debt. Payments Canada reports that between 2014 and 2019, cash transactions declined 38%, while electronic forms of payment grew to account for 81.6% of all payments in Canada in 2019. So we're seeing obviously a growth in volumes. And we're also seeing, as reported by money transfer provider PayPal, that there are 50% more payments globally that are, being processed in the same period. So the trends are accelerating, certainly in terms of, e-payments, payments that we would say as behavioral scientists are, intangible relative to cash payments. So what's the big deal? Is there really a big difference between a physical cash payment and something like an e-payment? Well, if we're thinking of rational choice theory, it would certainly propose that there's no difference whatsoever. One form has the exact same value as another. So, I'd be equally happy to receive an e-transfer of $100 as I would a $100 bill. Viewed, however, through a behavioral economics lens, what we know is that not all forms of payment have the same value. Even with physical currency, $1, it does not equal $1. We've looked at a lot of different examples of this in the research. So one example that makes this very clear is that the physical appearance of a bill will affect its perceived value. The newer it looks, the greater its perceived value. This type of assumption is similarly violated if we're looking into credit cards and on the repayment side of things. So if consumers have 2 credit cards and they can't afford to pay off the outstanding balance on both of them in a particular month, their decision of where to allocate funds is not based on which one is higher in interest. Instead, they're much more likely to put their money towards the balance that they can wipe out. Debts that are large and need to be paid down over time are counterintuitively less salient to people than debts that are small and can be paid down in one go. This is a really, really interesting finding. I think it's very counterintuitive and shows that we are predictably irrational. So that last example, I think it brings us to the heart of the matter, which is that intangibility has behavioral implications. The uptick in online purchasing during COVID-19 has meant that payments have become increasingly intangible. You're no longer in a physical environment. You're not pulling cash or even a credit card out to make a payment. In an online environment, you may not even be called upon to enter your details for payment. Maybe the app or the website remembers those details. It doesn't even feel like you're making a payment or that money's leaving your account. So what that means is that there's actually no pain of paying that's induced. And that is something, that pain of paying, that when it happens is a natural way of combating overspending. In many cases, for instance, with buy now, pay later products, as David was talking about, the pain of paying is even further reduced because it isn't even you who's paying. It's your future self who is a literal stranger to you. When the act of buying is separated in time from the act of paying, it's more likely that you're going to make the purchase, perhaps maybe even spending more than if the payment were in the here and now, in cold hard cash. Finally, circling back to the repayment side of things, we've established that people have a debt account aversion. They would rather wipe out an outstanding balance than pay down 2 accounts without paying off either one. We also know that people are more drawn to paying down debts that are connected to certain types of spending. In particular, debts that come from visible, everyday types of spending that we expect to repeat. Those are the debts that people are driven to pay off in advance of debts that come from less common types of spending that are easy to forget, that we don't plan to repeat very frequently. So people would rather pay down a credit card they use for something like grocery shopping, it's a visible spending category, than paying off a credit card they used to pay for something that was a one-time type purchase, like a vacation or that home redecorating project. When people don't expect to spend again soon in a particular category, they're less impelled to make room by paying down debt. applying behavioral economics given the intangibility challenge that is posed here. So there's a lot we could do preemptively to manage overspending, but I think the ideas captured here are really more on the repayments and credit management side of things. We've been thinking a lot about that. For one, we know people are motivated to feel like they've checked something off their list. And so we can make use of this natural motivator to help people build and maintain better credit behaviors. It's difficult for consumers to keep track of purchases they've made and how this might relate to an overall balance owing. So if the balance owing is high, he may even find that people feel that it would be a drop in the bucket to repay. What you can do is you can take that overall amount and you can chunk the balance into individual payments. So it's no longer $1,000 that you owe, it's $600. You spent it on your new bike. It's $200. It was those new shoes. It's $200 that you spent maybe on, some groceries. And we know people are going to repay more because people are motivated to pay off all of something than a part of something. So that would be one type of strategy we would be able to leverage. Now I'll pass things back over to David and he can round out our discussion of the trends in the area of real estate.
Thanks, Michelle. Real estate speculation and price appreciation is certainly an interesting topic. It's very current. Just this morning, Bloomberg released research showing that Canada is the second most overvalued real estate market globally after New Zealand. And this has been part of an upward trend, particularly in the last 5 years, but COVID has really accelerated this trend. Zillow has termed it the great reshuffling, where people are moving out of dense urban cores into exurbs, areas with lower population density. People are less comfortable in crowded spaces. As well, we're spending more time at home and people are trading up to find more space for a home office. That's understandable. The strange thing is we're seeing rents dropping in many urban cores as a result of this. With low interest rates, fiscal stimulus, pent-up demand, limited supply, increased savings from COVID-19, reductions in discretionary spending, which allow the accumulation of savings, and an expectation of the post-COVID-19 recovery, that's creating a lot of macroeconomic factors, but there's a lot of behavioral factors as well that are adding to what's looking to be like a perfect storm. The IMF is referring to this as excessive risk-taking and stretched valuations. The Bank of Canada is noting that mortgage debt is rising, home equity debt is rising, and mortgage credit quality is declining, with overextended buyers having high loan-to-value and high loan-to-income ratios. And now 20% of housing demand is driven by investor speculation. And there's similar patterns globally. In the US, the Cleveland Fed recently reported that 14% of all home purchases were second homes. And clearly, either intended for rental income, or speculation. Often the very structure of the real estate industry reinforces the speculative bubble with blind bids, no price discovery, commission-driven agents manipulating the sales process to create bidding wars. An observation, I spent decades in the securities industry, and that sort of behavior is illegal in the investment industry. The Bank of Canada is recognizing this, and they've created the Home Price Exuberance Indicator that's trying to identify those behavioral drivers of what they're referring to as extrapolative price expectations. When prices increase, people extrapolate, they assume it'll continue increasing, creates more price expectations, and it really becomes a self-fulfilling prophecy. Unfortunately, in the short term, housing demand exceeds the ability of supply to actually meet that demand. And the concern globally is that these extrapolative price expectations are creating a bubble that will eventually burst. Despite accommodative monetary policy and stimulation payments, inflation's been unexpectedly tame, but a rise in inflation expectations would trigger repricing downwards. Next slide. So this is an interesting chart. This comes to us from The Economist. It's really a great little tool that lets you compare home prices, both nominal and real, and you can compare house prices against rental and income. For me, the interesting thing here, there's two that are interesting. Anecdotally, I have people asking me a lot about the outlook for real estate and pricing. And many people say, well, real estate only ever goes up. It's the safest possible investment. But, the end of the 80s through to 2000 actually saw a decline in real house prices in Canada. So housing doesn't only ever go up. And as well, what you can see is going back 15 years to Q1 2006, US house prices have returned to the level they were at Q1 2006, whereas home prices in Canada have doubled. To me, that is concerning. The macroeconomic, I put on my economist, my financial analyst hat, and I can start to look at some of the financial and rational drivers of this, but there are a lot of people who are behaving in a way where they're boundedly rational. They're trying to be rational, but in fact, they are not being as purely rational as the economists would assume. So next slide, Michelle. Some of the implications here. People really are overestimating their knowledge and expertise. There's something called the Dunning-Kruger effect, and it's an interesting effect. Essentially, it describes the case where people overestimate their knowledge and capabilities. As an example, if you ask people about their driving skills, between 80 and 100%, depending on the country, report that they're above average drivers. Well, we know mathematically that's impossible. And it tends to be that the less people know about something, the more they think they know. And they often overestimate their understanding of complex calculations. That's particularly true in real estate. As an example, people will look at what they paid for their house and they'll say it's tripled in value. So for example, in the average home price in Toronto in 2006 cost $366,000, accumulated to a value of $1.14 million in 2021. Returns seem impressive. You ask people about that, they say they're up 311%. That's 1.14 divided by 366. Well, that's not actually the correct number because you have to subtract the original purchase. If you take the original 100% off, the net gain is 211 versus a gross gain of 311. And many times people will look at the 311 as being their gain when really it isn't. And then they have a difficulty comparing that to alternatives. The naive estimate of the annual return, someone says, well, I made 311% over 15 years. So, divide that and, that's my gain. Well, that's not actually the right number. The naive estimate of annual return over 15 years is 14% annually. They'll take the 211 and divide it by 15. But that ignores annual compounding. The actual annual compound rate of return is 7.8%. They also ignore real estate transaction costs, sales taxes, property taxes, and maintenance. And again, this is trying to compare real estate as an investment versus an alternative, perhaps an index fund. If you take away maintenance, which alone is 1% a year, then that annual return of 7.8 drops to 6.8. People say, well, that's still a great return. But that's far less than the rough estimate they make of 14%, unfortunately. Even if they start with 6.8%, if they compare that to the S&P 500 over exactly the same time period, it returned 10.6%, which means that housing yielded 3.8% less per year. In absolute, that doesn't sound like a lot. But if you're a 35-year-old home buyer and say you're buying an investment property with cash, the incremental return from the index would mean a level of wealth 3 times higher at age 65. So that's a mathematical example of people not really accurately calculating the returns. And failure to calculate those returns mean that they're making a misallocation or a suboptimal investment decision. In reality, home ownership has been more expensive than renting in Canada since Q2 of 2006. That tells me home prices will need to eventually decline relative to rental costs. What should happen in the long run is people realize that if they own this home, they could actually sell it, deploy their capital into the market, and they would actually save money doing that. In the long run, that would reduce the demand for housing, increase the demand for rental, and would reestablish an equilibrium. The challenge is people are just not looking at this as a rational decision. People tend to use heuristics and rule of thumbs. They tend to be biased by, overconfidence, illusory explanatory depth, the Dunning-Kruger effect. All of these behavioral factors mean that people aren't sitting and doing the calculation. They're simply buying real estate under the mistaken assumption that it's the best possible low risk, no risk investment ever, and they're not evaluating the alternatives. How do we then apply BE to help real estate speculation? If you trace a lot of it to the heuristics and biases rather than the sound investment fundamentals, we need to really counter that to protect lenders, investors, and renters alike. We should encourage people to think about, contrarian views. What could go wrong? As well, when shopping for a house, pre-commit to a maximum price to avoid the FOMO, the fear of missing out decisions. Because a lot of the market right now is being engineered by the sellers to create that emotional fear of missing out driven decision where people are overspending or spending more than they should. As well, people can engage in metacognition. That means thinking about thinking and how am I thinking? And really step back and remove the emotion, remove the heuristics, remove the focalism on just the trend and assuming it can only go up, and have a sober second thought. Another thing that seems to often drive these sorts of decisions is the greater fool theory. Think about GameStop. People were paying, $400, $500 for a share that had an intrinsic value below 15. But they did it under the assumption that some greater fool is going to come along and pay them more money for it. But you have to recognize that you are the lesser fool in that transaction, and you're still buying something far more than its intrinsic value. We really have to have a realistic appreciation of our expertise and seek an unbiased expert opinion. And by unbiased, I mean someone who doesn't have a vested interest, the seller or the realtor. It's very easy to go to real estate investment sites and see endless stories about, riskless gains and easy money, and debiasing us from that can help. As well, it's just useful to say what could go wrong. Put it down and say, what if there's a home price correction? What would happen to me if the price didn't appreciate? If you look at the rental market, people are often buying properties for rental where the rent doesn't even cover a majority of the mortgage. And they're doing it under the assumption that prices will keep going up and eventually they'll make their money that way. Well, what would happen if we had a repeat of the 1988 to 2000 scenario where in real terms, house prices declined for over a decade? That's not a really good investment strategy. But again, we have to debias and remove the emotion for people to realize that. So with that, I will turn this back over to Nate.
Thanks, David, and thanks, Michelle, for walking us through these trends. So we'll wrap up by considering just a few of the implications and how they influence financial institution policymakers and consumers and the interaction between them. So the first quite obvious point on the next slide is that behavioral science and behavioral insights are, they provide various insights that optimize long-term well-being. And this spans from the level of the individual to the organizational level to the societal. And on the next slide, we dig a bit deeper here. And from the vantage of financial institutions, we can recognize that there's cost savings by mitigating account escalation and collections. There's reputational risk management that can happen by reducing some of these punitive measures that we don't want to do. And broadly, there's risk mitigation happening through raising all ships, so to speak. From a policy standpoint, we can figure out some of the incentives and structures in real estate that might need to be made to ensure a healthy economy. We can start to think about housing supply imbalances, and we can consider how BE insights can more broadly enter into the policy development process for financial regulation. And as individual consumers, as David said, we can think about our thinking and become aware of these biases. We can become aware of the option to employ some of these nudges upon ourselves and seek these behaviorally informed products and services, and we can improve our own financial decision making. And as much as there are known solutions on the basis of existing research, perhaps the emphasis here should be on the broader unknowns. And on the next slide here, we invite you to become participants and engage with us through the Research Institute to construct and execute the research that's going to help us individually, organizationally, and societally navigate the new normal. As much as we can lean on past research as a mechanism to make informed estimations and devise strategy that's attuned to what is known about human behavior, when we look across the landscape today, and COVID-19 is arguably merely a catalytic event that is reinforcing and exacerbating existing trends that are a consequence of growing populations, changes in the dynamics as a function of emergent technology. And it was really gasoline on the fire. And what I'm getting at here, and what we emphasize from the vantage of the Research Institute, is that these are necessarily known unknowns. With these emergent trends and the shift into this new normal, there necessarily are questions that necessitate scientific inquiry in a coalitional fashion that brings together behavioral scientists like us, experts within the financial institutions and governmental bodies that are influencing and shaping these financial regulations and products and services. And so we'd like to invite you to engage with us. Go check out the website. And on behalf of all of us, David, Michelle, myself, and BE Works more broadly, we thank you for coming today and engaging with us in a foray into the new normal as it relates to credit, and hope that you will leave with both some practical insights about how to navigate this in your context, but more critically, what are the big questions that we need to come together to answer? So many thanks again, and we hope we'll talk to you again soon. Thank you.